Probal Sen, Senior Research Analyst, the oil and gas space, joins in with his thoughts on this pocket as well from ICICI Securities, of course. Probal, good having you. Thanks for taking the time out. This tape is repeating, but it seems that there are hurdles for crude at higher levels, and there is a penchant for crude to move lower. Somehow, we are not seeing a, how do I say, a trending, sustainable rally in the OMCs. What are your thoughts on this?
I think one has to keep the OMC earnings delta in a little bit of perspective, to be very honest. When you have a situation of steadily declining crude prices, obviously, on the one hand, retail margins, specifically in the current scenario where there doesn't seem to be any pressure to change the prices at the pump, obviously a reduction in crude and therefore product prices would have a downward effect, an upward impact rather on fuel retail margins. But one has to remember that while Somit did mention that GRMs have spiked quite substantially in the last couple of days, the fact is that directionally, if you look at what lower crude prices mean at this point of time from a demand perspective, GRMs, in fact, over Q4, if you look at it, are actually down about 2.3, $2.4 a barrel on an average versus the Q3 average, the Q3 reported numbers. Secondly, when prices actually go down, in a linear way, there is the specter of inventory losses that also comes through, and you have those accumulated LPG losses on which we still don't have much clarity on, whether they would be compensated in part or in full, or in what way will that actually happen. So the on structurally speaking, low prices in a narrow band are always a positive for Indian petroleum companies, whether it's oil prices or gas prices. And there is obviously an earnings delta if the retail margins actually sustain at the current higher levels of 7 rupees plus that they would imply. And there are fears that crude could go down even further. So obviously all that is a positive, but that has to be tempered by a small amount of cautiousness that GRMs could also sort of come down if demand sort of remains this tepid, and there could be some inventory and LPG loss impact that can offset some of this benefit.
Okay, so I'm just trying to understand, all things considered, Probal, and hi, Tamanna here. In terms of lower crude prices, good for Indian OMCs. In terms of overall demand, economy positioning, maybe that's not looking so good. So on balance, would you say that OMCs are looking like they're in for a spell of a better run-up? Which companies, in your view, are better placed right now?
No, I think absolutely. I do not disagree with the fundamental premise that OMCs stand to benefit if crude prices remain in a substantially lower band and sort of stay there. Definitely, OMCs could stand to benefit. Again, I repeat that this is based on a core assumption that there is no pressure to pass on any of these benefits to the final consumer, because that can substantially change the trajectory of retail fuel margins. So that being the case, I think HPCL, obviously stands to benefit the most, because in a lower price environment, when GRMs are perhaps not the driver of earnings growth, it's retail fuel margins, HPCL would obviously stand to benefit the most, and that is reflecting in the way that the prices have behaved in today's opening and maybe in the last couple of sessions. Also, the valuations have dropped substantially, so that makes it obviously easier to sort of get in and build positions from these places on. They are well below their 5-year averages. If I look at the last 1 year movement, obviously the stocks are down 20-30%. While that may not be unique to our sector, but it obviously makes things far more comfortable if earnings can see some upsides from these levels.
Probal, sorry, maybe you are repeating this, but I'm still inclined to ask you, because since the last 2 days, the delta that we've seen in the prices for the OMCs, particularly HPCL, right? Higher share of marketing margins, maybe all of that leading to it. But it's up nearly 12-13% from, let's say, last week's closing price. But with crude continuing to be lower, is there additional luck? Is the risk reward in favor for an investor after this short bout of rally that has already happened? Sorry, I'm making it short term, but just trying to get it clear for our viewers.
No, I think I would refrain, frankly, from commenting on whether it's a tactical buy or not from these levels. But if you look at what valuations are there, and if you even if you build in that crude basically stabilizes at somewhere between $65 to $70, which sort of looks like a likely scenario at this point of time, then all things considered, I would say that HPCL, BPCL, and IOCL in that order would continue to be a preferred pecking order, and all three names, given the kind of valuations that they've come down to, even after this rally, I think can continue to probably be absolute performers from here on in for the next 6 to 9 months.
Okay, yeah, sorry, I didn't mean to ask you to comment on whether it's a tactical buy or not. Just wanted to get that clarity that there is a rally that has happened. Right. Is it still a good investment candidate after the uptick that we've seen? So I'm glad that you clear that for us, Probal. The other question is then, what does this price downtick mean for upstream names, Probal?
So for upstream, I think it will be important to see what the absolute level settles at. As you would have seen, in any case, even when crude was at basically around $80 plus levels, the net realizations for these companies were anyways being held at around $73 to $75 a barrel, given the fact that windfall taxes were being imposed, and they were taking away the benefit above a certain threshold. So the absolute hit to them, if you really look at it, as long as crude holds above or close to $70, you're talking about a $3 to $4 hit, which is still significant, but not as significant as optically it would seem that $82 crude has become 68 or 70. So there is a hit that will definitely be there, and it is definitely a negative from a net realization perspective. But a $3 to $4 hit from what they have been doing in the last couple of years has basically a mid single digit kind of an earnings impact. And it can be tempered a little bit by the fact that their gas realizations now will continue to actually improve with the changes that have been made in the pricing policy, and the fact that every year the decline that they were seeing in legacy fields will basically be offset, or rather whatever they are doing to offset this decline to keep production at the same level, that portion of restored gas would be subjected to the new well pricing, which is almost a 25% higher price in effect. It's a 20% higher, formula, but it definitely is, given that there is a cap on the current price of $6.50, the effective price actually could be $2.50 higher for this new well gas. So on an overall basis, it is a negative, but I would say that the impact is probably lower than what it looks if you just take absolute prices into account.